Okay, let's dive straight in today. We are looking at Sumitomo Corporation, a business with, well, a 400-year history.
That's right. 4 centuries. It's quite something.
And our mission here is really to unpack how a company this old is trying to stay dominant, especially in the digital age. We want to understand its core DNA, what it's doing now, and what the latest numbers tell us about where it's headed.
Exactly. It's about going beyond just the surface level. What makes a company last this long? And how does that translate into, strategy today? It's a masterclass in long-term thinking, really.
So let's start at the beginning. 17th century Kyoto, Masato Sumitomo. He was selling books and medicines. Seems like a humble start for a global giant.
It does, doesn't it? But the key wasn't what he sold, it was how he thought. His founder's precepts were foundational.
The precepts, right.
And there's this one line that really defines everything. Benefit for self and others, private and public interests are one and the same. That's the core DNA.
That sounds, well, almost idealistic. Good business means doing good for society. But over 400 years, with mines, factories, was it always that clean? How did that ideal hold up?
That's a fair question. Think of the precepts less as a guarantee of perfection and more like a guiding principle, a North Star. It forced a long-term view, prioritizing the group's stability over, maybe quick, easy profits.
And that long-term disciplined approach, people still see value in that today.
Absolutely. You see it reflected in who invests. Warren Buffett's Berkshire Hathaway owns nearly 10% of Sumitomo Corporation.
Wow, okay. That's a huge vote of confidence. Buffett doesn't just invest anywhere.
Exactly. It signals that this isn't about speculation. It's about durability, discipline, diversification, a multi-generational view. They're betting on the strength of this 400-year-old machine.
So that machine's industrial engine really fired up with copper, right?
Yeah.
The Beshi copper mine.
Yes, that mine was critical. It wasn't just digging copper out of the ground. It fundamentally shaped the company. It helped fuel Japan's early industrialization.
How did it shape the company, though, beyond just providing revenue?
Well, to run a huge mine like Beshi, you need capital. So they started a bank. You need heavy machinery. So they got into machinery manufacturing. You need to move the copper and other goods.
So they created a trading division.
Precisely. That's the origin of the Tsukusha structure, the general trading house. It grew out of necessity.
Okay, Tsukusha. For listeners who might not know the term, can you break down what that actually means in today's world?
Think of it as a kind of ultimate global integrator. They don't just buy and sell stuff like steel or chemicals. They might invest in the mine, producing the raw material, finance the ships moving it, own the port facilities, maybe even the tech platform managing the whole supply chain.
So deeply involved at multiple stages.
Deeply involved across dozens of countries. They manage risk by balancing volatile commodity businesses with steadier service income streams. It's a complex, diversified model.
And the Sumitomo Corporation we know today, the trading arm, was formally set up in 1919, becoming truly global around the 1960s.
That's right. And today, they operate in over 60 countries. Iron, steel, chemicals, automotive, lifestyle goods, digital services, energy. It's this massive, globally balanced machine.
Okay, let's look under the hood of that machine, the traditional power sources. For the last full fiscal year, FY 2024, where did the big revenue numbers come from?
The usual suspects, really. The core industrial and trading businesses, iron and steel, chemical solutions, transportation and automotive, and energy-related activities. Those were the big drivers.
But it sounds like the really interesting story isn't just maintaining those, but reinventing them.
Exactly. That's the strategic pivot. They're taking these core traditional strengths and aiming them squarely at the future. Take steel, for example.
Okay.
They're not just selling basic structural steel anymore. They're focusing their industrial metals know-how on making things like offshore wind monopile foundations.
Monopile foundations. Let's pause there. What are those and why is that shift significant?
Sure. They're basically the huge single steel columns that anchor those giant offshore wind turbines to the seabed. The legs, if you will.
Okay.
By shifting production towards these, Sumitomo is essentially turning its traditional steel business into a key enabler for renewable energy. It's future-proofing by linking directly to the energy transition.
That makes sense. Blending the old industrial base with new sustainability goals. And we see that elsewhere, too. Construction systems in North America, sustainable cities in Asia.
Yeah, and those sustainable city projects are classic Tsukushusha. They're not just building houses. They're integrating real estate, energy efficiency tech, digital networks, the whole package.
And digital itself seems to be emerging really fast as a growth engine.
Definitely. This isn't just about, selling software packages. It's about building the underlying infrastructure. They've got their subsidiary SCSK, and they just acquired Net1 Systems. The goal seems to be building a major digital infrastructure platform across Asia Pacific.
Right. And alongside tech, they're pushing into what they call impact sectors.
Yes. Things like healthcare, maybe services supporting hospitals or aged care and agribusiness, especially focusing on growth markets like North America, Latin America, and Southeast Asia.
All this change, these big investments,
Yeah.
it must require incredible financial discipline, which brings us to the numbers for FY 2024. That 400-year history seems to show up here.
It really does. Look at the balance sheet discipline. Their debt-to-equity ratio is just 0.6. That's remarkably low for a company doing huge global projects and acquisitions. Very little leverage.
And the credit rating agencies agree on the stability.
They do. Moody's gives them a bond 1, S&P gives them an A. Both are solidly investment grade.
Okay, and for listeners, what does an A or BA1 rating actually mean in practical terms?
It basically signals very strong creditworthiness. It tells the market that Sumitomo's ability to meet its financial obligations is high, even if the economy hits a rough patch. That stability is key for funding those really long-term infrastructure projects.
Profitability looks decent too. Return on equity at 12.4%, return on assets at 5%. But the real test, especially during a transformation, is often cash flow, right?
Absolutely. Operating cash flow for the full year was strong, $612 billion. But the crucial number, I think, is free cash flow.
Which is the cash left after investment.
Exactly. It came in at $150 billion for FY 2024. That's cash generated after making significant investments in growth. It shows they're largely funding their own transformation internally without piling on debt. That's real operational strength.
Okay, now let's jump forward to the very latest numbers, Q1 of fiscal year 2025. The headline profit figure looked pretty impressive.
It was striking. Profit attributable to owners hit $170.9 billion. That's a big jump from $126.3 billion in the same quarter last year.
Wow. So how does that stack up against their goals for the full year?
Well, their full-year target is $570 billion. So in just the first quarter, they've already achieved about 30% of that goal. That's a very strong start.
And cash generation kept pace.
It did. Net cash from operating activities was up nicely year over year, reaching $120.1 billion.
But the number that really caught my eye in that Q1 report was the free cash flow. You mentioned $150 billion for all of last year.
Right. And in just Q1 of this year, $107.7 billion.
That's huge. Up from only $19 billion in Q1 last year. A massive jump.
It's dramatic. Nearly a 470% increase year over year for the quarter. This, I think, really validates the strategy. It shows that all this investment and asset reshuffling isn't just happening, it's actually generating significant cash right now.
And they manage this while keeping that debt level low.
Exactly. The net debt to equity ratio held steady at that conservative 0.6x level. Financial stability remains paramount.
So what drove that big Q1 profit surge? Was it just underlying business booming, or were there other factors?
It was really a combination of two things. Solid performance from the core operations, definitely, but also some significant gains from strategic moves, specifically their ongoing asset replacement strategy.
Okay, let's break that down. The one-off gains.
The big one was a older $28 billion gain from selling their Midas tire retail business in the U.S.
Midas. Okay, so that's a clear example of them shedding a legacy asset, right?
Textbook example. They take capital out of a business like a U.S. tire chain, which probably has slower growth prospects now, and they free it up to reinvest in those higher growth areas we talked about, digital, renewables, healthcare.
Any other temporary boosts in Q1?
Yes, the real estate division had a strong quarter, but that was partly due to the timing. They delivered several large properties all within that 3-month period. So a bit of a concentrated effect there.
Got it. And on the recurring side, the ongoing business strength, where did that come from?
The digital business continued its solid growth, boosted by bringing Net1 Systems fully into the fold under SCSK. Automotive finance did well, benefiting from lower credit costs. And the leasing and aviation businesses provided steady, reliable contributions.
Were there any areas that faced headwinds? It can't all be smooth sailing for a company this diverse.
No, you're right. Commodity prices are always a factor. Mineral resources profits actually dipped a bit because coal prices were weaker. Higher copper prices helped offset some of that, but not completely. And the energy transformation segment profit was slightly down compared to Q1 last year, but that was mainly because last year's number included some gains from asset sales that just didn't happen again this quarter. So more of a comparison effect than a fundamental weakening.
So if we were to quickly recap the Q1 segment stars.
Automotive was the clear standout, 39.7 billion profit, driven by that Midas sale and the finance operations. Real estate, or what they call diverse urban development, was also very strong at 36.2 billion, thanks to those property deliveries.
And steel.
Yeah.
Benefiting from the wind turbines.
Steel was modestly higher at 18.8 billion. Yeah, getting a lift from that offshore wind demand. Transportation and construction systems also chipped in nicely with 20.9 billion, helped by leasing and some vessel sales.
What about the transformation areas like digital?
Media and digital came in at 8.4 billion. You're starting to see the positive impact of integrating Net One there. Mineral resources, as mentioned, dipped to 10.6 billion due to coal prices. Energy transformation posted 24 billion, slightly lower because of fewer asset sale gains compared to last year.
Okay. So the big picture from Q1 seems to be core businesses are holding up well, maybe even improving, and the strategic selling off of assets is actually boosting overall returns right now.
That's the key takeaway, I think. The divestments aren't just happening, they're contributing positively to the bottom line and, crucially, generating cash without hurting the company's ability to invest in future growth. It shows the plan is working.
And this all feeds into their bigger picture plan, the medium-term management plan running to 2026.
Exactly. They've set a pretty ambitious goal, aiming for $650 billion in annual profit by fiscal year 2026.
And how much of that is supposed to come from these new growth areas?
That's the critical part. They're explicitly targeting $100 billion of that total profit to come specifically from the new growth engines, digital, energy transformation, healthcare, agriculture, and next-gen leasing.
So they're putting a number on the transformation bet.
A very specific number. And they're backing it up with serious capital. The plan is to invest over $730 billion into these high-growth sectors,
while at the same time continuing to prune the older parts of the portfolio, like the Midas sale, or they also sold T-Gaia recently.
Yes, exactly. They're replacing hundreds of billions of yen worth of what they see as legacy or lower return assets. It's a continuous process of optimization.
And Q1 really shows that plan in action then.
It does. You see the divestment gain from Midas. You see investments like Net One Systems in Japan strengthening the digital push, or Active Style in U.S. healthcare boosting that impact sector. It's this simultaneous pruning and planting. And crucially, it's strengthening cash flow, not straining it.
Okay, let's talk valuation. Where does the stock sit now, given all this? You see intrinsic value estimates around $4,240 per share, which is about, what, $27.70 per ADR?
That's about right. And just quickly for listeners, an ADR, or American Depositary Receipt, is just a way for U.S. investors to easily buy and hold shares of a foreign company like Sumitomo in their U.S. brokerage account.
So comparing that estimated value to the current market price, around $4,457 or $29.20.
Right.
What does that suggest?
It suggests the market is pricing it pretty close to fair value right now.
Yeah,
it's not necessarily deeply undervalued like it might have been previously, but it doesn't look particularly expensive either, given the performance and strategy.
Which inevitably leads to the question of risks. What could potentially derail this story for a company this large and complex?
Well, the commodity exposure is inherent. Prices for things like coal and copper go up and down, and that impacts earnings. That's part of the Suksha-Shin model you accept.
Currency fluctuations too, I imagine.
Absolutely. A stronger yen means profits earned overseas in dollars or euros translate back into fewer yen, hitting the reported numbers. That's always a factor for global Japanese companies.
And then there's the transformation itself. Execution risk.
Definitely. Integrating big acquisitions like Net One Systems smoothly, delivering on massive, complex projects like offshore wind farms. These things require precision. There's always a risk things don't go exactly to plan.
But the argument is that the sheer scale of their diversification helps mitigate some of that.
That's the counterbalance, yes. If one sector faces headwinds, another might be doing well. Weak coal prices might coincide with strong auto finance performance, for example. It provides a level of resilience.
So wrapping this up, Sumitomo seems to be at this really interesting point, leveraging a 400-year history but actively reshaping itself.
I think that's right. It's this intersection of deep tradition and quite radical transformation. They're trying to build a digital and sustainable powerhouse on an incredibly solid, centuries-old foundation. The financials look robust, and management seems laser-focused on executing this plan.
So maybe Sumitomo isn't the stock for someone looking for explosive, short-term growth. It's more about long-term value, stability, and this very deliberate, measured evolution.
That feels accurate.
The question for you, the listener, then becomes, do you believe in the kind of transformed, digitally focused, sustainable, yet still diversified company Sumitomo is actively building, funded largely by its own impressive cash generation?
It's a compelling narrative of disciplined change. The Q1 results really underscored that they are moving capital decisively away from slower areas and into what they believe are the growth drivers for the next decade and beyond. It's a powerful story playing out. And just a reminder, we are not certified financial advisors, and this content is only for educational purposes. If you are considering making any investment decisions, please consult a certified financial advisor.